Anybody trading this action? It's a crazy day today. So we almost filled the gap here. I mean, why wouldn't they allow another 5 points or so? Let's see, 89, let's call it 90. 5 points. Just fill the gap and just reverse down. It just, they tried again here and it just got slammed. It's insane. What's 5 points? I mean, it's a 100 point move down from 380 to 280 almost. I mean, this is how you blow accounts. You go long, you lose. You go short, you lose. This is just pure sideways right now. But I'm just waiting for this gap to fill, because once they fill the gap, now they can go down. And retest this low here of 21 to 20. But it looks like we might get a second chance here at this gap. Third chance, I mean. Problem is right here. These overnight 200s. I mean, just 10 points above it. Here we go, finally. This gap should have been filled on this bar with this bottoming tail. It's insane. Or even the third one. But no, they just playing games, I guess. Now we're probably gonna go to about 430. 40 area. Unless we reverse on this bar. Go down. Anybody make any money in this market? Lose any money?
Government borrowing, current administration, potentially higher inflation as well. I think it's interesting that the tariff risk has been traded as an inflation risk, certainly in the bond market. All of those things coming to fruition. Look, there's a lot of debt that needs to be refinanced. And one thing we're going to talk to Treasury Secretary Yellen about is, they have issued a lot of short-term debt bills. So when those have to be refinanced, that is at higher.
I wanted to see if there's any news. What's going on here? A lot of indecision here right now. So let's see what's on the news.
In honor of the Treasury Secretary's outgoing interview here, guys, I did make two charts, which I think are the highs and lows of the Bidenomics legacy. So on the good side, the economy has just been better than anyone expected. Here's GDP, and the Fed started raising rates in 2022, and everyone expected recession. And guess what? We basically had 3% growth, 2 to 3% growth. That has been a positive story, and it's why all the recession odds went down. It's why all the forecasters were wrong on the stock market and on the economy. And she has been right. The downside has been the inflation story. And if you look at CPI, no question about it, we have come off those super high levels in June 2022, which was around 9%. But we're not all the way down to 2%, and Americans are still clearly feeling the cumulative impact of that. And the question is, how fast can we get back to 2%? What is causing this inflation? Could the administration done something differently? And what can we expect from an incoming administration that is threatening tariffs, which could also be inflationary? These are all some serious questions, but the inflation and the growth story front and center for the bond market and for the Treasury Secretary. So we're going to be talking a lot about that, David.
Yeah, that's a key issue today. B of A's got a note out this morning, quote, if tariffs are imminent, the cutting cycle could be over. Upside risks for...
Looks like I could be right here. So we did fill the gap, and now we're reversing. So if we take out all this congestion here, we're going lower.
That as a group, but now they are, and they're down sharply. This on comments from NVIDIA CEO Jensen Huang. Kate Rooney's here to explain what's going on. Kate.
Hey, David. Yeah, good morning. So those quantum computing stocks you mentioned down double digits today. NVIDIA CEO Jensen Huang pouring some cold water on how useful this technology will be in the near term, said at CES in Vegas that utility still many years away.
If you kind of said 15 years for very useful quantum computers, that probably be on the early side. If you said 30 is probably on the late side. But if you picked 20, I think a whole bunch of us would believe it. But what we're interested in is we want to help the industry get there as fast as possible.
He also claims NVIDIA will play a significant role and part in creating those computers. Quantum computing, guys, is different than classical computing. To step back here, it uses quantum bits or qubits instead of what are known as regular bits. So basically it can perform complex calculations a lot faster than traditional computers. If you check out the stocks, so you got names like Rigetti, IonQ, D-Wave, and quantum computing. There's also the Defiance ETF. You can see today down all of these names, 40% in some cases. The sector, it's been on a tear in the past year or so, partially due to Google's Willow chip breakthrough. Rigetti, one of the names I mentioned, was up almost 1,500% last year. The rally is really reflective of this hunt for the next big tech wave out there. It does come after many watch this AI and semi-rally play out. So there's a lot of investors chasing this momentum. Not just Jensen, though. There's a lot of skepticism right now about valuations and the technology in terms of the promise there. It could help power data centers, but some of those real-world use cases, guys, have not materialized yet. Back to you.
Kate, well, I'm sure not the last we've talked about quantum in the months to come. Kate Rooney this morning. Meantime, NVIDIA shares are rebounding a bit after posting their worst day since early September. The semis overall are off to a pretty good start for the new year, up about 4%. Wedbush analyst Matt Bryson joins us this morning with the buy rating on NVIDIA, 175 target. Matt, it's good to see you. I think it's interesting that so much attention on CES, and the halo effect has almost been as powerful as the NVIDIA effect on itself. Commentary about Toyota, commentary about Samsung, all coming out of Jensen this week.
Yeah, certainly. So, I mean, partly it's what we've seen in semiconductors over the last year, 2 years, right? NVIDIA and AI have been moving the entirety of the market, and they've been pulling names that either are also involved in AI, like Marvell and Broadcom, or names that supply NVIDIA, like Samsung, alongside them. So it's been what we've been seeing, or it's a continuation of what we've been seeing, I think.
We talk a lot about market concentration. The same dynamic exists within semis itself. You got the sector at an all-time high, but only 1 in 5, I think, above the 200-day. Do you expect there'll be a broadening within semis too?
Yeah, I think the problem is that you have a very robust spending environment for data center AI, And then at the same time, we have a not so robust spending environment for almost everything else. So whether it's consumer electronics, industrial applications, enterprise spend, they're all kind of lagging. And I think what's not helping that portion of the market is there's a whole lot of uncertainty around what we get with the new administration. So do you see tariffs that force shift to manufacturing? And because of that uncertainty, it's hard for companies to plan. And so I don't see things changing right now. I think AI continues to do well, and everyone else kind of tries to figure out what's going on with the world economy moving forward.
Do you expect the tariff picture to clarify in, let's say, the first half?
I mean,
who knows, right?
Yeah, I mean that's the problem, and that's the problem with all these companies. They want certainty around planning, right? You don't want to build a new facility in Mexico and find out that all of a sudden your investment isn't worthwhile because you've got this tariff penalty that's been applied.
Is NVIDIA the top of your universe at the moment in terms of favorites?
NVIDIA is up there. I personally like Taiwan Semiconductor a little bit more than NVIDIA, but these are all gradations.
And finally, we mentioned Toyota and some of the automotive stuff. Is that we've talked a lot about weakness in auto as an end market? Do you see that reversing?
I think that you need the consumer to reverse. So whether it's the U.S. consumer, whether it's a worldwide consumer, that you need more momentum there. And I think not just for autos, but across technologies, a lot of the new things that people are talking about, so autonomous driving, for instance, with autos or AI and PCs, really interesting, can create these refresh cycles, but we need to see it starting to get applied. And so I think when you start to see both a better consumer and those technologies show up, that's when we get spending a broader semi-recovery, if you will.
Matt, appreciate it. Such a huge week, obviously, as we've been awaiting these keynotes for a while. Talk soon. Matt Bryson, thank you. Meantime, firefighters are battling against that wildfire that's forced evacuations in the Pacific Palisades neighborhood in Southern California. Nearly 50,000 people now have been ordered to evacuate, and thousands more have been told to prepare to leave. Let's get back to NBC's Chase Kane. Chase, we were just talking about not just the horrific pictures, but also the economic effect, which we'll have to come to terms with in the coming days.
Carl, I mean, yeah, anyone who knows this area, this is a rather affluent area. The Pacific Palisades, I mean, Malibu is just a mile or two up the Pacific Coast Highway. If you could see through the smoke, which you certainly can't right now, the famous Santa Monica Pier with that big iconic Ferris wheel, that would be just behind me. We were positioned this way because as the sun started rising, the smoke was clear, and so you could see daylight there. But now the smoke has shifted again. And so we are in Pacific Palisades again. This is the Pacific Coast Highway. That's Sunset Boulevard, the Sunset Boulevard here. As these winds have been just relentless overnight, 30, 40, 50 miles an hour sustained, we've had wind gusts, at least a couple of wind gusts reported above 100 miles an hour. We're talking major category strength wind gusts. That's made it virtually impossible for firefighters to get a handle on this. Across any of these major fires burning in Southern California, there's no containment. They're burning thousands of acres, but they're burning thousands of acres of densely populated areas. I mean, Santa Monica is partially under evacuation. It's just out of sight here. You actually can't even see hardly across Pacific Coast Highway, but there's a couple of condo buildings there. Carl, but we've seen embers and flames spark up as these winds kick up and then die down. Firefighters scrambling back and forth. They're bringing in firefighters from as far away as Northern California and Arizona, Carl, to try and support the efforts here. But really, until these winds die down, it's going to be impossible for them to get this under control.
Hey, Chase, it's David here. You know, what is the threat to, you mentioned Santa Monica, obviously a lot of concern there as well as one might expect, especially given a relatively dense housing pattern there. What is the threat there at this point, or are the winds sort of going the other way?
I mean, the winds are generally moving away from Santa Monica, but the evacuation does extend to San Vicente Boulevard. They're sort of on the northern end of Santa Monica, if you're familiar with it. We drove into Santa Monica, or drove through Santa Monica this morning. Power's out through part of the area. There's more than 300,000 people without power. Some of that is intentional, where they're shutting down the power to try and, prevent new fires from sparking. And sometimes it's just branches or power lines coming down in these strong winds and knocking out more power, as you can kind of see here in the darkness behind me. I mean, the sun is up, but it sure doesn't feel like it right now.
Okay.
How
Chase,
the local
thank you.
authorities are responding. Oh,
Sorry, Sarah. Go ahead.
I just want to, I mean,
I'm
not
sorry,
to
repeat that
make it too
for me one more
political.
time.
Obviously, no, I know that there's a crisis there, and not to make it too political, but I saw that Rick Caruso, who's a successful businessman, unsuccessfully ran for mayor of LA, was recently on a local channel and said that there's no water coming out of hydrants, and critical of the mayor of LA and how the authorities are responding. What's your sense of how they're dealing with this?
Yeah, so Rick Caruso was talking about the ability to fight the fire in Pacific Palisades here just up Sunset Boulevard, where he owns the Palisades Village, a pretty well-known shopping center. He was complaining that there wasn't enough water for firefighters to protect that property. What they have pointed out here is that this part of Los Angeles is powered by water tanks instead of a traditional underground line. So there's just not as much water pressure there. That's what he was referencing. But yeah, there have been political comments. I mean, when you heard Gavin Newsom out here yesterday, he was talking about, hey, President Biden, the federal government is here helping us. There's no bickering. There's no fighting. So even though he didn't use the name of President Trump, that was certainly what Gavin Newsom was alluding to. So unfortunately, there are political undertones in what really shouldn't be, because this is just a heartbreaking, devastating, and frankly dangerous situation still.
Chase, thank you. Chase Kane joining us. Give us a sense of what the things look like on the ground there, David. This is a tough one.
Yeah, very. And as obviously was just indicated, very, very dangerous and so much at risk. Obviously, you start with people's livelihoods, their homes, and everything else. As you might imagine, though, there are plenty of investors who are also focused in part because, as you need to, in terms of what the insurers would be. Carl, these are very valuable homes that we're talking about in the Pacific Palisades region and others. And so any number of people are taking a look at some of the names, whether it be a State Farm, a Chubb, and on from there in terms of what the potential losses could be given just the catastrophic nature.
Yeah. Meantime, SoCal Edison cutting power for another 114,000 customers because of the wildfire risk. So you got the power outages on top of all of that. As we go to break this morning, take a look at the roadmap for the rest of the hour. Shares of Palantir in correction territory now after the worst day since early May. We'll get a closer look at what's behind the move.
Plus, we're going to talk about the state of commercial real estate. The CEO of RXR, his name is Scott Reckler. You've heard from him before, I know. He's going to join us. He's going to give us his latest read from the ground.
And tech coming off its worst day since mid-December, but our next guest says it's still worth buying here. He'll tell us why after a quick break. Big show still ahead. Squawk on the Street. We'll be right back. Don't go anywhere.
family business.
Welcome back to Squawk on the Street. The NASDAQ tech overall coming off its worst day since December 18th as yields remain elevated. That said, our next guest remains bullish on the sector, along with communications, services, and financials. Keith Lerner, Truist Wealth Co-Chief Investment Officer, joins us now. And Keith, I know you've liked tech for a while and you remain bullish, but 10-year yield at 4.7, does it change things?
It doesn't change our longer-term outlook, Sarah, but it does suggest we're in this kind of internal correction period that's really started back on December the 6th, which coincided with the low in yields. So I think yields in themselves are creating a bit of a headwind here. When you look below the surface and say, why are yields moving higher? You know, inflation expectations haven't really moved that much. Really, the uncertainty factor that was called term premium is the main factor. So I think, in general, we have this market turning beneath the surface. Yes?
Keith, I'm sorry. I got to cut you off because your audio it's echoing. So we're going to try to work on fixing that and get back to you, hopefully, so that we can hear you. But clearly, you know, Carl and David, the 10-year move, it's caught some people by surprise. It's happened fast. Stocks never quite like it when you kind of see this sharp, fast move higher in the 10-year and in the 30-year yield, especially when it raises questions, bigger long-term questions about supply and who's going to be buyers of treasuries and persistently long-term deficits and what's going to happen with the new administration. That feels like it's nagging. And when you look at a long-duration group like a technology, which is built on these higher valuations for future profitability, there are questions and potentially why you haven't seen. Carl, you mentioned the halo effect from the NVIDIA keynote speech at CES and all these bullish announcements. It's coinciding with this move in rates.
Yeah, bond volatility highest since November 19th. And at the same time, you talk about valuations. I would note a couple comments about valuation this week alone, David, from Howard Marks and then Fed Governor Cook on Monday, saying in some areas of the market we might be priced for perfection and vulnerable to a sharp decline.
Yeah, I think that concern certainly gets raised at this point. And Sarah, you raised it earlier as well, just interest costs also, with the expectation perhaps they'd be coming down as rates started to come down. Well, no such luck at this point. And obviously a very important component of the overall budget is the cost that we're paying on interest for all the debt we have, $37 roughly trillion.
I know, it's crazy. Ever since the Fed started cutting rates, they've gone on a one-way ticket higher. Keith Lerner, we fixed your audio from Truist. So thank you for bearing with us. On tech, we were just wondering if the 10-year moving up to 4.7, the 30-year moving to 5%, if that changes things as far as how you look at valuations around tech in particular.
Sure, Sarah. Hopefully you can hear me okay now.
Yes.
So I would say in general, our view on tech is still positive, especially on a relative basis. I think on a shorter term basis, the market's going through an internal correction that began in late December. And if you look at the S&P 500 as a whole, the market peaked back on December 6th. Well, what happened on that day was that's where yields had bottomed. So I do think this is a near-term headwind for the overall market. And you also had back in December really high investor expectations that's getting reset. So in our view, we're having a reset of sentiment. Yields are a bit of a headwind, but we still think the primary trend is higher. And when we think on a relative basis, and you look at tech, the earnings momentum for tech is still stronger than the overall market. That tends to be the main driver of performance. And then lastly, even though we've had a really strong 2 years for technology as a whole, over the last 3 years, it's outperformed the overall market by about 33%. If you go back to the technology bubble period, you know, it outperformed by 250%. So all in all, with all the different headwinds and cross currents, we think tech is in a good position on a relative basis.
So is that
Now the two dogs got stuck in the fire in California.
Hi. Just be okay. You're gonna be okay. Hi. You're gonna be okay. Oh shit. Welcome to the park. Yeah, don't worry about that, dude. Look at that. Oh shit. Scary, huh? Yeah. Okay. The plastic is gone, dude. Yeah. Fuck.
Instead of filming this, why don't you just Try to do something, right?
Shit. So, where's the gas? Outside. Okay, the gas is off right now. No, don't open the window. Don't open. Don't open anything. Just stay over here. Fuck.
Huge cash flow margins. And we have the secular tailwind that's going to be where spending continues, even if the economy slows down somewhat. So on a relative basis, we still like that. One thing we are doing because of that risk is we're pairing that large cap and that tech exposure with mid caps, which should benefit from some of the pro-growth policies. And it's cheaper and less concentrated. But overall, our preference is large caps, mid caps, and then small caps.
Got it. Keith, thank you very much for joining us, especially on another day here where tech is lower. Keith Lerner from Truist.
Sarah, just a week into 2025, some of the biggest gainers on the S&P to begin the month. We talked about the NVIDIA effect and those comments about Micron have those shares up 18% so far. As we head out, check out shares of Instacart today as well, rallying on news. It's being included into the S&P Midcap 400 effective January 14. Stay with us.
Inside Wealth.
Welcome back to Squawk on the Street. I'm Contessa Brewer with your CNBC News update. Attorney General Merrick Garland says he received the final report from special counsel Jack Smith detailing why he chose to charge President-elect Donald Trump in 2 federal cases. Garland says he intends to publicly release the portion of the report that deals with the accusations that Trump tried to overturn the 2020 election, but will not release the portion that describes claims that Trump hoarded classified documents. An appeals court is reviewing a motion by Trump's co-defendants to block that release. President-elect Trump today asked the Supreme Court to block his sentencing in his New York hush money case, arguing he should be protected by presidential immunity. The High Court asked New York prosecutors to respond to that request by Thursday morning, tomorrow morning, so that the justices can have time to act before the sentencing, which is scheduled for Friday. And former President Jimmy Carter will lie in state at the U.S. Capitol for a second day today and remain there until tomorrow morning, when his body will be taken to the Washington National Cathedral for his state funeral. David, that's the news.
Contessa, thank you. Still ahead, the chances of a rate cut later this month now just stand at 7%. That at least is according to the CME. What is that going to mean for commercial real estate? Well, we're going to discuss that and a lot more with RXR Chairman and CEO Scott Reckler. That'll be next. We're back right after this.
What did they capture here in this video? Watch this video here. Look at this. What was this? What do you think that is? A rocket? UFO? I mean, look at this market. So we did drop, like I said.
Welcome back to
Tested the lows of the overnight and moving back up. Wow, is this going to be the kind of day for the day?
in this new year. Happy New Year. Happy New Year. You know, when I've talked to you in years past, whether it was 2024 or 2023, you certainly didn't sound that positive, kind of waiting for the storm to come, so to speak, the banks to deal with the decline in value of so many of these loans. Where do things stand now?
So, you know, I think it's interesting. Really what has happened is I think the Federal Reserve, by using their rhetoric, was able to keep the markets loose, right? The stock market's up, the bond markets were open, and the regulators sort of gave some room. So this storm sort of hovered around the coast, but never actually came onto the coast. And then during that period of time, You saw the big banks, they were taking reserves. People were capitulating on values. People were estimating where interest rates are. And so I think 24 is the floor right now. I think 24, we're at this floor where we're now going to be in a position to start dealing with these things, but it's not going to be as distressed as it was because the capital formation has happened. I think an acknowledgement of valuations and the reserves are in place. So it will start taking place. We'll see transaction activity take place.
We will, but we're also so extend and pretend is sort of we're at the end of that.
I think people who waited in 24 hoping that interest rates are going to go low and save them are going to have a really hard time surviving in 25. For those that recognize that, okay, there's this moment of reprieve, let's use 24 to be strategic. Let's go negotiate with lenders, reduce your basis, be opportunistic, position yourself. You can thrive in 25 because rates are higher for longer. So even though we have, I think, better fundamentals in terms of tailwinds in the economy and just talking about the office market, much stronger, we still have a challenge of all these loans, $2.3 trillion of loans that have to be refinanced. The bulk of that over the next 3 years at rates that are going to be much higher than where they were originally set.
Well, you started a distress fund, I think it was last year.
Last year, yeah.
Have you done anything from it?
So we've this year invested in 9.5 million square feet of Class A office space. And we started by buying institutional owners' interest who just really didn't want to be anywhere near. Office was toxic. We were buying it at discounted prices and going to the banks, renegotiating and bringing down the basis. So the concept is buy great buildings with broken capital structures, fix the capital structures, and then places like New York, you get them leased. More recently, we've been working with institutions that say, okay, I am now getting more constructive on office. I see the demand out there. I don't want to abandon it. So even this week, we're planning on closing another 2 million square foot acquisition where we're going to buy a 49% interest in a Class A trophy building with an institution that says, okay, I want to stay in for 51%, but I want to hedge my bet, bring in someone that's going to bring fresh capital to ensure I'm not putting good money after bad.
Right.
And the capability to be able to do the capital projects, the leasing, refinancing that needs to get done.
On office, have cities been smart about conversions to the degree that's soaking up some of that inventory?
Yeah, and we've talked about this in the past. In New York in particular, I think, it has been smart because we knew it was going to happen. And we thought that if you got the right policies in place, it would actually accelerate that. And they did put in policies, the state did, and then the city did with the City of Yes housing program. And so what you've seen is a dramatic increase of buildings that actually qualify for conversion. So there's, about 12 million square feet of conversions going on in New York City right now, and not just in Lower Manhattan, but we're working one on Times Square. We're working some in Midtown right now because the math works because of these tax abatements that you're being able to generate.
Although there are some of these buildings, the floor plans don't allow for it, and they are kind of in a place where they're not going to get the workers back. They're B buildings. I mean, there are going to be zombie buildings.
Absolutely.
What do we do with them?
Yeah, I mean, and that's the process, right? Some are just going to be torn down, right? We're tearing down some old buildings and going to build new office buildings, and there's great demand. I mean, what you've seen, that flight to quality. Just
let me stop you right there. There's great demand for building new office buildings.
Listen, we're going to build a 2.8 million square foot office building right next to Grand Central, right near One Vanderbilt,
which is gets the highest rents in the city.
We're going to break ground this year, and why? Because it's going to be delivered in 2032, and when you look as to where the major companies, the biggest, fastest growing companies like Citadel's doing itself and JP Morgan's doing, they want to be in brand new buildings. And there's no more brand new buildings. I mean, the people that have taken that space, they can't even expand in that space right now. And if you look where rents were this past year, in Midtown Manhattan, we were actually back at 2018 volumes on leasing. And rents, we had $100 rents, 212 leases, a new record, 10 million square feet of $100 and above rents. And we had over 22 leases at $200 a square foot, 560.
We're back. So it really is a tale of two cities. I mean, completely. Yeah. It's like if you're an A building or you're new, everybody loves you. They want to be there, and if you're not, you're out of luck.
That's right. And the thing is, on new construction, since there is no new construction coming on market, we're seeing what we had talked about in the past. They'll go down to the next level, right? So they're coming down to the A quality, well-located buildings with the right amenities. And those buildings had been renting, let's call it at the $80, $90 a foot, are now going $100, $120 a foot because of the scarcity of large blocks of space in those high quality buildings.
So New York, I mean, with Bill Rudin, he's a chearleader, though. He was with us recently. I tend to find you a little more realistic sometimes. Love Bill. You seem to be very positive, though, too, on New York.
Yeah, listen, and as you said, I'm usually fairly realistic and somewhat skeptical, I'm very, very bullish. And we wouldn't have invested, we're investing $2 billion in this 9.5 million square feet of buildings that we're doing. We wouldn't be doing it if we didn't see the demand. And the reason it is because the demand is there, right? So if you can get the right basis, you know you're going to lease this up. I wouldn't do this in San Francisco because I know my colleagues that are doing this in San Francisco, they're buying great basis, buying it really cheap, but there's no tenants to lease the space. In New York, there's tremendous demand. And this demand, by the way, has been happening without tech companies, right? This has really been financial services, private equity.
Really?
Now, all of a sudden, Amazon saying everyone come back to work. They didn't have the space. They're scrambling to find space to bring people back, right? So you've now seen the tech companies back in
Amazon that would have once had a headquarters here, if not for our incompetent city government.
How do you ladder retail, warehouse, data center? We got another announcement yesterday from data center investment from friends of the president-elect in Mar-a-Lago.
Right. Yeah, I mean, listen, I think data centers obviously the hot sector right now. I always get a little bit nervous on hot sectors. It reminds me a little bit of the tech bubble where everyone's building the infrastructure as if they're going to be the one that survives, and there's maybe not as many survivors, right? But I will still say there is structural issues in capital structures in the commercial real estate market, right? I mean, we've talked about multifamily as an example. There's $500 billion of multifamily loans that are maturing over the next 3 years. And again, those loans, or propensity of them, were either floating rate loans or done at really low rates. And so they're going to need to be meaningfully recapped, re-equitized to be able to get through the process. And if rates are higher for longer, which I think is the norm, which is what's going to be the case, there's going to be a lot of losses that are going to have to be ultimately dealt with in a lot of those regional banks.
Yeah, but not systemic, though.
Not systemic because the big banks, had a very small percentage of commercial real estate and were able to use their earnings and growth elsewhere to build reserves.
As they had that time.
Exactly.
Finally, it's almost 5 years since the beginning of the pandemic. We started this segment talking about 5 days a week at JP Morgan. Are we really seeing it? Are buildings starting to be full almost every day of the week?
Yeah, I would say starting last Labor Day, we really began to see every day but Friday. Now, I think with these commitments of, we're back 5 days a week, I think you're going to start seeing the Fridays starting to happen as well. And listen, this builds on itself, right? When Goldman Sachs says it, JP Morgan says it, Amazon says it, all their competitors say it, and it will now be over that hump. And I know we've been saying this for 3-4 years. Okay, people coming back this year, people coming back. They're back. You go to our buildings, you're waiting for elevators to get back up into the buildings. We're back to like 95% of where we were pre-COVID.
Scott, I can't remember having you seen so positive in years.
No, it's good. It feels good, but it's again, as I said, there's still challenges ahead.
Sure, of course.
And on the capital structure side, but you have strong economic macro tailwinds, and that's across, I think, all the area here right now. Right? I think that's the dichotomy here is that with the new administration, people feel the animal spirits are out there right now, but we still have issues that we got to deal with. But that momentum, I think, will push us through that.
All right. Look forward to our future conversations around it. Thanks for today, Scott.
Thank you. Appreciate it.
Scott Reckler, RXR.
All right, guys, quick programming note as we head to break, less than half an hour away from an interview you will not want to miss. Treasury Secretary Janet Yellen here live from the Treasury. Squawk on the Street returns after a quick break.
the world.
One of the biggest trends in the market over the last year is the convergence of key sectors like tech, energy, and utilities. That's all thanks to the booming interest in artificial intelligence. Now, with ever-growing demand to power AI infrastructure, could nat gas be a possible beneficiary? We're going to talk to a trader to see how to play it. Tune into our Market Navigator segment later on today on Power Lunch, 2 p.m. Eastern Time.
For what's ahead.
Statements coming from the CEO of West Steel called the President of the United States corrupt. As an American, I feel offended. This is just absurd.
That was the CEO of Cleveland Cliffs last night on Jim Cramer's Mad Money, firing back at the CEO of U.S. Steel. As the battle over the fate of this company heats up, Goncalves raising issue with U.S. Steel CEO David Burritt, who spoke with us right here on Squawk on the Street earlier in the day, yesterday, accusing President Biden of tainting the review process for Nippon Steel's proposed acquisition. Listen.
It is a remarkable deal, and that's what we're trying to do. We're trying to right the wrongs of this president and make sure that CFIUS is actually followed. The process has been corrupt. I know it. You know it. I mean, let's face it. God knows that this process has been tainted from the very beginning, and we need to fix it.
You know, David, I know you've been following this very closely, and what happens next, clearly U.S. Steel and Nippon Steel have some legal battles to try to challenge this presidential order. But no question, the fact that Dave Burritt, in our interview and in his statements and in the lawsuits, is now making this about political corruption and accusing the Biden administration of that, certainly gives Republican lawmakers something to hang on to if they were to take his side. It's a much better selling point having that as the story than having a foreign takeover of a historic U.S. steel industry company, if they were to get behind it, say, and potentially that goes for President-elect Trump as well.
Yeah, it's a strategic approach they're taking. It's sort of appealing to President-elect Trump, as you said. Interestingly, Sarah, he did not mention U.S. Steel yesterday. There were some who thought perhaps he would in that long-ranging and wide-ranging press conference he held.
Oh, Trump, that is. Yeah. And you know, it's interesting, David. I'm here at the Treasury, and the CFIUS committee, it's an interagency governmental committee, but it is chaired by Treasury Secretary Janet Yellen. So we're going to ask her about that, see if she'll be able to talk about it at all, given that there are lawsuits. But now that there are questions about the integrity of the process, there are some questions.
Definitely worth asking, Sarah. We look forward to that in the coming moments. Meantime, Palantir shares coming off their worst day since May, now down double digits just this week. We'll talk about what's behind that move when Squawk on the Street continues in a minute.
Palantir was one of the best performing stocks in the S&P last year so far. And of course, it's very early in the year, though. Different story. Seema Modi's been tracking that action. Seema.
David and Carl, we've been pulling data from SEC filings, which does show that the Palantir stock underperformance has coincided with a bit of insider selling, all pre-planned, but worth noting around $45 million so far this year. Separately, investor Kathy Wood sold about $15 million worth of stock. Morgan Stanley earlier this week pointing to those valuation concerns. Even with the recent unwind, we would point out shares are trading at around 148 times forward earnings. That's among the highest in the IGV software ETF. Others trading at higher multiples than their peers include CrowdStrike, Datadog, and SentinelOne. While investors are no doubt bullish on software playing a critical role in the build-out of AI, revenues for the sector are expected to decelerate this year. Mizuho analysts see 2024 revenue growth decelerating to 15% versus the 22% growth we saw in 2024. They're forecasting the pace of sales growth to drop to 13% in 2025. What's really driving this, guys? Competition, stronger dollar, and what some analysts call a more moderate view on the return on investment of AI, which is something we talk about a lot for the semiconductor industry. Software has now underperformed 9 of the last 10 trading days, and Bank of America traders there say clients are still actively looking to put money back into the sector because there are a number of tailwinds when you take a step back, looking at not just artificial intelligence, but this incoming administration, the prospect of more M&A, which is expected to help this specific subsector within tech.
Okay. We also got some of these reassurances on things like scaling walls and Micron memory from Jensen this week at CES, right?
Sure, and there's certainly a rollover effect that it can have on software, and you build GPUs that are in these data centers, but you need the software that it can run on, right? So it's a two-part story.
Seema, thank you. Seema Modi. All right, one of the keys to this market has been Treasury rates on the 10-year at least, hitting 4.73. Great subject to discuss with Treasury Secretary Yellen. She's next when our live market coverage continues.
Good Wednesday morning. Welcome to Money Movers. I'm Carl Quintanilla, live at Post 9 of the New York Stock Exchange. Sarah Eisen is at Treasury in D.C. A lot more on that in just a moment. Right now, trying to unwind some opening losses today. We're back above 5,900 as yields continue to inch a little bit lower this morning after hitting about a one-year high earlier today. Sarah?
And that's where we're going to start with Janet Yellen. I am here in D.C. in the cash room of the Treasury Department. In just a few minutes, we will sit down here with the U.S. Treasury Secretary, an exclusive exit interview, her last, before leaving. We'll talk about the economy. We'll talk about these rising Treasury yields and what they signal. We'll talk about the deficit as well. A few weeks ago, she said she was sorry that more progress wasn't done on the deficit. So we'll talk a little bit about some of the concerns that investors have right now when it comes to the debt trajectory, of course, inflation, and much more in just a few minutes here, Carl.
Yeah, on a day where they're having some meetings in D.C. on the Republican side about reconciliation bills, and we'll see how that legislation shapes up in the months to come. Meantime, let's kick off with some markets. Our next guest does see the S&P finishing the year at 6K, just a modest gain, with the index currently hovering around 5,900, predicting some pretty wild swings in sentiment and a surprise winner to watch abroad. That would be China. Joining us this morning, Cantor Fitzgerald Chief Equity and Macro Strategist Eric Johnston. Eric, great to have you. I got to go right to China. What do you have in mind?
Sure. Thanks for having me. So, China is obviously undergoing a massive stimulus package that we think is likely going to grow over the course of this year. There's an overhang right now around tariffs. And, our view is that it is in both parties' interest to get some sort of a deal and probably to get it relatively early. So we think that overhang can be alleviated by a deal fairly early within 2025. At the same time, positioning is extremely low in China. People have given up on it. Valuations are super attractive. And the bottom line is that you have a government where, failure is not an option for this stimulus package. They're going to do, I think, whatever it takes to get both the economy to stabilize and to start growing again, and also to get stock prices higher. And I think you want to be on the same side with what that type of government is looking to do.
That's interesting. It has felt a bit extreme looking at record low bond yields over there, the flight of capital, but you do see something happening there. Meantime, back stateside, we've been talking a lot about Fed pricing in terms of cuts basically going away for the first half of the year. I don't think you're expecting any in the first half either.
We are not. The market right now is pricing in one cut in the first half of the year. We think they're going to be on pause for at least the next 6 months. We were not necessarily in agreement with cutting the 100 bips that they did already. And I think what they're seeing is that you're still seeing CPI and PCE well above 2%. You had an ISM services new orders number, prices paid number yesterday that hit 64. And we have a very pro-growth administration coming in. So I think there's a lot of reasons for them to take a pause, wait and see what policies are implemented, and also see what happens with inflation. If inflation does start to reaccelerate to the upside, I think the market's going to have a big issue with that. And I think that there are reasons to believe that that is certainly a possibility. And so I think the Fed's not going to want to take a risk of cutting any further until we have real clear evidence that that's not the case.
Eric, it's Sarah. I'm listening to you. I'm trying to figure out what your posture is toward equities at the moment, because most of last year, I believe you were pretty negative and pretty bearish on stocks and the overall economy. Have you changed your tune?
So in terms of the market, we had a much more trading oriented view last year. In terms of the economy, we think we're in a late cycle economy. We still believe that. We also think that the next 3 to 6 months, with the new administration coming in, with confidence sort of surging, especially among CEOs, that the next 3 to 6 months are going to be very strong. And the wealth effect is providing a big tailwind there. So between housing and stock prices, the wealth creation over the past, call it 6 to 9 months, has been so great that we think that's also going to carry forward. So, and you're seeing that in the economic data, and we think that continues at least for the next 3 to 6 months. and then we're going to see where rates are and whether that has some sort of negative delayed impact in terms of the long end of the curve.
We did get a number out of ADP today, though. 122 was the lowest since August. And we keep hearing from Fed officials about the labor market normalizing, and that would be a path to cut if, in fact, they were going to do so. Do you think the job market softens?
So I don't. I think that, certainly in the short term, meaning the first half of the year, I think the labor market is going to stay strong. Now, there are some nuances around the number around immigration and how that affects the actual payroll number. But I think the labor market is going to stay very tight. And also there could be some impact around wage inflation from the new immigration policies. If you look at some of the most recent jobs data, the JOLTS number yesterday, for example, really took a leg up. And I think that's part of the, sort of surge in CEO confidence. If you look at the small business index post the election took off. And so I think this is all sort of correlated that business managers are starting to now, invest or reinvest. And that's why you're seeing the job openings pick up, jobless claims fall. And we do think that continues, that strength continues in the first half of the year.
What kind of implications would that have for this long-awaited broadening of the market away from a very small number of powerful and large tech companies?
The broadening is tough because of the move in rates. And, our view has been that, we've been negative bonds, that yields would move higher. We think that's likely going to continue. And so if you have a yield that is in the high fours, or if it were to touch 5, a lot of the companies that are, part of the broadening trade have much higher debt levels. And so when people see yields rise, the larger mega cap type names who are running net cash positions, not relying on the bond market, can actually benefit from higher rates in many cases. I think that's where the money is likely going to go. So I think the broadening trade is tough. Also, from a defensive sector perspective, as yields move higher, those dividend plays look much less attractive.
Yeah, that explains certainly some sector activity lately, but definitely provocative, Eric, especially on the China thing. That would be an out of consensus call.
Yep.
We'll revisit that at mid-year, I'm sure. Thanks for the time. Good to see you, Eric Johnston.
Great. Thanks for having me.
Up next, an exclusive, wide-ranging exit interview with U.S. Treasury Secretary Janet Yellen. We're back in Money Movers in just a moment.
.com.
Welcome back to Money Movers. She has been at the forefront of economic policy making for decades, now gearing up to depart from her post in what is becoming a crucial time for America's fiscal future. Joining me here exclusively at the Treasury Department is the Treasury Secretary, Janet Yellen. Thank you so much for having us here.
Pleasure. Thanks for the invitation, sir.
Yeah, we were just reminiscing here early 2021 in the depths of COVID, testing in the room behind me to get in. A lot's changed.
A lot has changed.
The economy has been resilient, and you've been right on this point. Everyone expected recession, interest rates are rising, inflation was raging, and yet, amazingly, the economy has maintained this 2-3% growth. The question is, why was it a losing issue for the Democrats in the election?
Well, we have seen really solid growth, and we did experience a surge in inflation. And most people who are alive now never lived through an episode like that. The level of prices is about 20% higher than pre-pandemic. And of course, the rate of inflation has come way down. It's now pretty close, quite close to the Fed's target. So prices aren't continuing to rise at anything like that pace. It's now very close to normal. But people, I think, remember these big price increases, and they feel it had a very adverse effect on their cost of living. Now, at this point, wages have also gone up a lot. And if you compare the typical household now to pre-pandemic, they are ahead in real terms. They can buy the same basket of goods they could have in 2019 with, we estimate, about $1,600 left over to spare. So in real terms, wages have outpaced inflation. And now, over the last year or more, on a consistent basis, wage increases are outstripping inflation. But there was a period in which price increases were very high.
Yeah, it still feels like that because we remember the pricing from 2019 before COVID. And in some places, especially at the grocery store, prices are so much higher than where they were then. When you look back on it, do you have any regrets about all the fiscal stimulus and extra spending put in place, adding fuel to the fire when it comes to sparking that kind of high inflation?
So I think it's important to remember what the world looked like when we entered the beginning of the Biden administration. We had a pandemic that was raging out of control, and thousands of people were dying on a monthly basis. And the unemployment rate remained extremely high. And many people who had lost their jobs, although they were being supported by unemployment insurance, were in a position where they could lose the roof over their heads. And we saw people in cars lining up at food banks to make sure that they could feed their families. And it was really important to spend the money to alleviate that suffering, to make sure that small businesses didn't go out of business because of the pandemic. People would have lost their livelihoods, their businesses that they had invested in. And we wanted to alleviate all of that suffering. We had seen in past downturns like during the Great Recession that people who are unemployed for a very long time become scarred. They become alienated from the workforce, and they can never get their lives, many of them, back on track. So I call that scarring, and we really wanted to avoid that, and I think the spending was necessary.
Did it spark the inflation?
It may have contributed a little bit to the inflation, but by and large, the inflation was a supply-side phenomenon. The pandemic had led to shortages of goods coming from China and other parts of the world, had shut down, left firms like our auto firms without enough semiconductors to be able to build cars. So there was simply huge supply chain problems, and critical goods that people wanted were in absolute shortage. And I think an important factor in the inflation was that these shortages started pushing up prices a great deal.
But then it went into services too. And right now, even as we sort of look to this last mile, most of the inflation is in the services part of the economy.
Well, wages have increased, but they're not increasing at a pace that threatens inflation. What we're seeing in part in the service sector is a continued impact of pandemic problems. For example, the huge increase in demand for housing. Slowly, it is passing through into rents. So rental price increases for new apartments and houses, they've moderated. But it takes a long time before all the renters in the country see their rents adjusted up to current levels. Similarly with insurance, where we've seen big recent increases. Well, the price of cars went up.
Yep.
The economy got back on track. The cost of repairing a car and getting the parts for it has gone up. And so for a prolonged period of time, the pandemic is leaving its impact on price increases as these adjustments continue to take place.
Is 2% in sight? Because it's been a little sticky here around these levels.
Yeah, so the CPI inflation rate is just a little bit above 2%. Similarly for the Fed's index that they watch, core inflation, excluding food and energy, is a little bit higher. And we haven't seen too much progress in the last couple of months, but I feel pretty convinced that we're on a downward path and that the labor market is not an ongoing source of inflation. The labor market has cooled and is in a very similar good state like it was prior to the pandemic.
So I wonder what you make of these rising treasury yields today. I mean, surpassing 4.7% on the 10-year, pushing against 5% on the 30-year. What does that tell you?
Well, one factor is the likely future path of short-term rates, which market participants try to divine when they decide what they're willing to pay for a longer-term bond. And when we see strong data on the economy, continued strong growth, and a strong job market, and some, over the last couple of days, surprises to the upside on indicators of the performance of the economy, that suggests that the path of interest rates going forward may be a little bit higher than people expected. I think there's also uncertainty that has increased about where the economy is going, what future policy will be, and the so-called term premium in interest rates over the last number of months looks like it's gone up as well, although from abnormally low levels.
Should the Fed stop cutting rates?
It's my last couple of weeks, but I'm still not going to comment on Fed policy. I I think the Fed does its very best to pursue the two objectives of price stability and full employment, and leave that judgment to them.
Well, I can't wait till after you leave and you can comment on both policies. But I'll ask it another way. Has it surprised you that rates have gone up as the Fed has started cutting rates?
Well, one factor is that, as I said, the term premium that was holding long-term rates at very low levels has begun to normalize. And the U.S. economy is simply doing very well.
Mm-hmm.
The economists called the U.S. economy the envy of the world. Growth continues to surprise to the upside. We have solid consumer spending, investment spending, and the like. And that's in spite of the fact that rates are higher than well above where they were during the pandemic.
What about the deficit? I wonder how much. I mean, there is increasing concern about persistently high long-term deficits.
So I do believe that fiscal policy needs to be put on a sustainable course. That has been a priority for the Biden administration. We submitted a budget to Congress in our last budget for 2025 that proposed $3 trillion in deficit reduction over the next 10 years. I think that's necessary to get fiscal policy onto a sustainable course. Of course, we've also been building up the capacity of the Internal Revenue Service, both to provide decent customer service and to modernize its technology, but also to be able to better collect the taxes that are due. And I think it will be very important to keep that on track. If all the money that was allocated in the Inflation Reduction Act to modernize the IRS, if all of that were repealed, as some have proposed, that would be an $800 billion hit to the deficit, as CBO calculates it. And in a higher interest rate environment, the interest costs have gone up considerably, and that's another reason why we need tighter fiscal policy.
I think a lot of people would challenge what you just said about it being a priority for the Biden administration, especially when you just turned in a 2024 fiscal year deficit of $1.83 trillion. Outside of COVID, outside of a financial crisis, outside of a war with U.S. forces, that's unprecedented.
Well, interest rate increases have led to higher cost of servicing the outstanding debt. That's one factor that's been involved. But discretionary spending is at historically low levels. We do have an aging population. We've known for decades that as that occurred, that would boost the cost of Medicare, Social Security, and Medicaid. And that process is ongoing as baby boomers retire. And these are all factors that are creating an issue of fiscal sustainability. And I'm disappointed that we've not been able to work with Congress to do very much on this front. President Biden did sign a bill that reduces the deficit by $1 trillion over 10 years when the debt limit was raised, but we've proposed substantial additional deficit reduction, and I think it's important for Congress to take that up. Now, many of the features of the provisions of JCTA that was passed in 2017 will be sunsetting at the end of this year. And this will be an important issue that Congress and the new administration will need to take up. And I certainly have heard that there are members of Congress who would just like to see all of those provisions extended and possibly do even more to cut taxes. And CBO has told us that would boost the deficit if that's done by $5 trillion over 10 years. So my hope is that this will be done in a responsible way, maybe focusing on middle class tax cuts and looking for additional revenue raisers. You know,
it's hard to imagine Congress getting serious about the deficit without some sort of crisis or bond vigilantes.
Well,
isn't it?
I would hate to see it come to the bond vigilantes. I think investors around the globe count on the United States to be responsible in managing its fiscal policy and not to rely on market responses to produce that deficit reduction. And I certainly hope that the new administration will take this seriously. You know, as I said, an easy thing to do is to make sure that the Internal Revenue Service is adequately resourced so they can collect the taxes that are due under current tax law. And it's estimated that something close to $1 trillion a year of taxes that are due are not being collected. So that is a very easy place to look for deficit reduction.
What about DOGE? What about Elon Musk and his Department of Government Efficiency, whose mission is to shave $2 trillion in government spending through waste programs and other cuts? Is that realistic?
Well, it's hard to see how the math on that works. Discretionary spending, namely what's funded through appropriations, is at close to historically low levels as a share of the economy. Defense is around $1 trillion spending, and non-defense discretionary spending is a little bit less than that, closer to $900 billion. So that's $2 trillion right there, and many feel that defense spending should go up. Mandatory spending, which includes Social Security, Medicare, and Medicaid, you know, these programs are important to Americans. Both Democrats and Republicans have indicated support for these programs, and they're very popular among Americans. And so it's hard to see where there can be substantial cuts there. And that takes one to taxes, and
they want to keep them lower. Yeah.
Well, so it's hard to see.
You don't buy it.
Well, it's hard to see how you could solve the deficit that way.
What about the debt ceiling? You just warned that we are going to hit the debt limit, in the next week?
Sometime between January 14th and 23rd, we expect to hit the debt limit. And then what happens is that Treasury has a series of measures that they can take.
Should we just get rid of it? I mean, is Trump right on this? You've called it disruptive in the past as well.
I have for a long time. I've said that I think the debt limit does not play a constructive role in fiscal policy. The real decisions that Congress makes have to do with expenditures, transfers, and taxes. And the Treasury Department, the President, and the Treasury Secretary are charged with carrying out those spending and tax plans. And when there are deficits, it's necessary to issue debt to finance and make good on past decisions that Congress has made. To arbitrarily come along and say, but you can't issue the debt that's necessary to fund expenditures that Congress has authorized is really not a constructive situation. And I don't believe it plays a constructive role in having a good and stable fiscal policy.
One of the other highlights of your tenure has been your visits to China. And I was there. I got to see, on your last visit, how well received you were. I mean, they were obsessed with what you were ordering for dinner, and they were praising the skill that you used when it comes to chopsticks. So I am curious to ask how you felt about the recent hacking of the Chinese, of the Treasury Department, and reportedly of senior offices, including your own, and whether you took that as an insult.
Well, we have reported as a major incident that Treasury was hacked. It involved a cyber attack by a state-controlled Chinese threat actor on a third-party software provider that we use. And we've detected this, and we'll be doing detailed reporting to Congress in line with our responsibilities. I had a video meeting with my counterpart, Vice Premier He Lifeng, just on Monday night, and this is something I certainly raised. And it is, of course, a tremendous concern to us that there was no access to secure or classified information. This affected a number of workstations at Treasury, but it's not something that builds confidence in our relationship, and we will and have taken action against perpetrators of cyber attacks from China and other countries. Just last week, we placed sanctions on a cyber attacker from China. So we will act, but it doesn't help our relations. But
no.
I do think we have built a much more constructive and stabilizing relationship with China over the last couple of years. And I believe my visits have played a positive role. You know, before 2023, there were almost no contacts between senior U.S. and Chinese officials. And I think that's a dangerous situation because misunderstandings can take place. There are no channels really to voice concerns over behavior of the other party. And of course, it's necessary in some areas for China and the United States as the world's two biggest economies to cooperate, to collaborate. And it's important both for China and the U.S., and it's important for the rest of the globe. And I do think our channels of communication have improved substantially. And, you know, we have very frank and tough conversations. And it enables me to explain what our concerns are with Chinese policy. You know, all along in my visits to China, and this would include my session on Monday evening, I've expressed concern about China's overall macroeconomic policy.
I know, yeah.
That is, you know, just a tiny share of GDP relative to other economies goes to consumer spending. And China is using vast subsidies to try to support a set of advanced manufacturing industries.
No, I know that was a big thing for you on the trip. I mean, we'll see where this goes. But just on the China front, I do want to understand the decision on U.S. steel, because it feels like China controls, 60% of the world's steel production. We have a deal here for one of our closest allies, Japan, a company to buy a U.S. steel company and invest billions of dollars. How is that a threat to national security? Because you do chair the CFIUS committee that was split, and then President Biden blocked that deal.
So this is an important case. I think, as you know, there is ongoing litigation over this case.
Oh, yes.
And as head of CFIUS, I regret there is very little substantive that I can say to you about this, other than that CFIUS did analyze the specifics, as it always does, of this situation, and prepared a thorough analysis to go to the president. CFIUS advises the president.
So it wasn't fixed by President Biden with his public remarks against the deal from the beginning?
I'm not going to comment on the specifics. We provided an analysis as we're required to the president, and the president decided this issue.
I know you've had a conversation with Scott Bessent, who President-elect Trump has nominated to take your position. What's your impression of him?
Well, he's somebody who certainly had a good deal of financial market experience. And for somebody who's going to be managing roughly $35 trillion of Treasury debt and responsible for financing the government and playing a key role in economic policy, I think that's a very helpful background. So I'm pleased to see somebody with experience who will be taking over, presumably, if confirmed by the Senate.
And what about you? What's next for you?
Well, I'm going to take a vacation for a little bit.
For the first time in a while?
It's been a while since I've had a good vacation, and probably I will go back to the Brookings Institution and in some capacity and do some writing and reflecting on my experiences over the last 40 years.
It is pretty amazing that you were the first female Fed chair in history and the first female Treasury Secretary in U.S. history. I do wonder if you think you've experienced any unfair treatment or criticism because of being a woman.
So I would say that I have had enormous opportunities, and partly because we have focused more on how few women reach the most senior levels, and I think government and our administration and past administrations have made a real effort to make sure that the pool of people who are considered is diverse. And I am really privileged with the opportunities that I've had. I feel strongly that economics can contribute to good economic policy making, and I've been honored and privileged to have this opportunity, these many opportunities. And you know, what's been really salient to me in all the work that I've done at the Fed and here at Treasury is how outstanding our civil servants are.
You've always said
They're
that.
really a national treasure. They are a repository of unbelievable expertise and experience, and mainly what you do in jobs like Fed chair and Treasury secretary is work closely with a staff of experienced individuals who are really highly motivated and capable in trying to make the best possible policy. It's the thing that I've most enjoyed about the work that I've done here and at the Fed. And
which job did you like better?
They're both different, and they were both terrific jobs. I really wouldn't want to try to rank them.
I think I'd prefer Fed chair.
You know, there is a vast set of responsibilities, and you know, ranging from sanctions to international responsibilities, tax policy, administration of, you know, the Treasury administered roughly $1 trillion worth of ARP programs, from rental assistance to, getting out the child tax credits on a monthly basis. And it's a really critical range of responsibilities. And I've enjoyed all the jobs that I've been fortunate to hold.
Well, we are very fortunate that you have taken the time to talk to us today and all the times throughout the last 4 years. So thank you very much for having us.
Thanks so much, Sarah. I appreciate the invitation.
Yes, that is outgoing Treasury Secretary Janet Yellen. Carl, back over to you.
Sarah, a lot of meaningful headlines on rates and inflation and deficit spending in China. Thanks. We'll get some reaction to what we just heard from Eurasia Group's Ian Bremmer in a moment. Plus, these fast-moving developments out of Southern California. A lot of headlines after this recent presser now about the out-of-control wildfires spreading across Los Angeles. Stay with us.
Welcome back. I'm Contessa Brewer with your CNBC News update. We continue to follow breaking news out of California, fast-moving wildfires in Los Angeles, mandatory evacuation now of at least 80,000 people, 300,000 people without power, and now at this hour we know at least 2 people have died. The largest of these fires, the Palisades fire, which local fire officials say has grown to more than 5,000 acres. Again, this is a densely populated area. We know it's destroyed 1,000 buildings. It sparked about 10:30 Pacific time yesterday in Pacific Palisades, which of course has a number of celebrity residents. LA County's fire chief says it's not contained at all at this hour. Locals are trying to flee from the fire, many of them abandoning their cars in gridlock traffic as the flames quickly spread yesterday. And you can see by the video, they had to use bulldozers to get those cars out of the way, trying to clear a path for emergency services. And then multiple other fires have ignited. So, for instance, this Woodley fire is now burning in the San Fernando Valley. The Hearst fire has burned 500 acres. It's in the San Fernando Valley near Pasadena. The Eaton fire has grown to more than 2,200 acres in the Pasadena. That's the one in the Pasadena area. And officials say that is the one that has caused 2 deaths so far. The National Weather Service says these strong, historic Santa Ana winds reaching 80 and gusts reported up to 100 miles an hour are fueling the flames, expected to continue into tomorrow. We will stay on top of it. Carl, for now, I'll send it back to you.
Officials calling these fires unprecedented, Contessa. Thank you, Contessa Brewer. Meantime, the fate of TikTok. By the way, let's watch markets here as we've gone green. The fate of the TikTok ban will soon be in the hands of the Supreme Court as it prepares to hear arguments on Friday. As today's one of the TikTok shop's e-commerce rivals, Whatnot, secures a massive new funding round. Our Deirdre Bosa has some details from her exclusive interview with Whatnot CEO in today's Tech Check. Hi, Dee.
Hey, good morning, Carl. So if TikTok Shop introduced American users to live stream shopping, Whatnot has also been making inroads, and it's ready to seize the opportunity should TikTok go away. Now, the LA-based startup this morning announced new investment at a $5 billion valuation. That is a 34% jump from its last valuation in 2022. It is also a rare non-AI startup attracting big dollars in the current venture capital landscape, which has been especially tough for e-commerce. Now, we spoke exclusively with Whatnot's co-founder and CEO, Grant LaFontaine, who said that it's not just AI companies that can build strong businesses.
This like meme in the world that maybe like consumer is dead or some of these other segments of the market aren't doing particularly well. And, you know, the truth is at the end of the day, if you're creating a really great business, consumers love it, and you have a strong underlying business model, you're able to go and raise capital. And, you know, it's not just AI companies that can build really strong businesses. Nothing's changed.
Now, this round, which was over $200 million, is evidence of that and could also suggest that investor interest in consumer brands is recovering. For the right company, of course. LaFontaine told me that Whatnot doubled sales to $3 billion over the last year and does have a path to profitability, though it's not now profitable. In public markets, too, guys, there's also eBay today at a 52-week high after announcing a partnership with Facebook Marketplace. Now, Whatnot has actually been around longer than TikTok Shop and doing live stream shopping. You can see an example of it here. But TikTok's reach has helped it become much larger in terms of sales, really eclipsing Whatnot. When I asked Grant if he saw a potential TikTok ban as an opportunity, he said, sure, they can be a home for buyers and sellers looking for a new one, but otherwise it's business as usual. They're going to stay focused. Back to you guys. Okay, Deirdre, thank you very much. Deirdre Bosa. Still ahead, reaction from Eurasia Group's Ian Bremmer to that exclusive interview with Treasury Secretary Yellen, thoughts on China, on the incoming administration, and more, right after a quick break. Welcome back. We heard moments ago from Treasury Secretary Janet Yellen here in the cash room, reflecting on her legacy and the relationship she's worked to cultivate between the U.S. and China. Have a listen.
Of course, it's necessary in some areas for China and the United States as the world's two biggest economies to cooperate, to collaborate, and it's important both for China and the U.S., and it's important for the rest of the globe. And I do think our channels of communication have improved substantially.
She was very proud of that, actually said that before her, there weren't those open channels of communication, though she also said the recent hack of the Treasury does not help the U.S.-China relationship. Joining us now with reaction is Eurasia Group founder and president Ian Bremmer. He also just released a new report outlining his top political risks to watch worldwide in 2025. Ian, the progress that Janet Yellen has made with her counterparts in China, what happens to that under Trump 2.0?
Yeah, well, first, Sarah, I do think she is right to take some credit. The relationship between the U.S. and China got worse before it got better under the Biden administration. You'll remember that initial summit they had in Anchorage, Jake Sullivan and Tony Blinken and their counterparts in China, and it was a disaster. The Chinese basically lecturing them in return and walking out. But the last year has really been much more stable. They've worked on the relationship. They've opened 25 high-level bilateral channels, including with Treasury, but commerce, defense, very important. And they've done it to stabilize the relationship without the Americans giving away the store. Tariffs haven't been removed. You still have the export controls. The U.S. isn't giving up on Taiwan, anything. So, I mean, really, you talk to Democrats and Republicans on the Hill, they don't have a lot to criticize Biden about on China. And they're not usually shy, right? So I do think she's right to lean into that. But it's very unlikely, in my view, that relationship, that state of affairs between the U.S. and China will persist with the incoming Trump administration, in part because of the orientation of his top advisors in cabinet, and in part because Trump's focus on tariffs, which I certainly think he is going to come out swinging in the early weeks.
How do you think that China reacts to that? Because on one hand, it's very confrontational, but on the other, he invited Xi to his inauguration. Nobody's ever done that.
That's right. And remember, Trump always talks about how brilliant Xi is as a strong leader, how much respect he has for him. It's not like Trump has a problem meeting with people he doesn't agree with. I mean, think about Kim Jong-un last time around. And Trump loves the idea of cutting deals. But this is a different environment. I think you're going to have a really hard time, even though they're going to have pleasant conversations, with what Xi is willing to offer. I'll buy some soybeans, I'll buy some treasuries, I'll buy some Boeings if any are being produced. But that's not going to be enough to get the Trump administration to back away from what is a much more hawkish orientation, not just on China bilaterally, but also in cutting the Chinese off at the knees in all the third countries that they are shipping goods through to the United States, like Mexico, facing a lot of pressure on China from the incoming Trump administration, India, Vietnam. This is something that the Trump economic team is very, very focused on, and it's going to hurt the Chinese.
Isn't that the whole point, Ian, around the universality of tariffs, is to get around that label washing?
That's right. I mean, the Chinese government felt like they have had a pretty good strategy in doing that. And the Trump administration intends to stop it. So, in other words, I think that there's an orientation to cut a deal if the Chinese were really willing to, sort of take a knee and cry uncle for the Trump administration. But I don't think that's going to happen. China's not Mexico. It's not Canada. It's not going to just be browbeat into a deal. And I think, again, at the symbolic level, they're willing to pay off Trump to make him go away, but the demands being made by the Trump administration are much more substantive and structural than that. So, and I'd pay more attention to the fact that the Chinese are doing a lot to try to improve their relationship with India, pulling their troops back from the contested border. Japan ending the export controls they've had on all of the seafood that they said was tainted from Fukushima. A whole bunch of other countries. Why are they suddenly doing that all over the world? Because they are preparing for a much more challenging relationship with the United States. And they also know that there are a lot of countries around the world that are equally unhappy with Trump coming in, and China's hoping that maybe they can make common cause with some of them.
Meantime, Ian, it feels like the street, at least, doesn't really know what to do with that press conference yesterday and these threats to expand American territorial sovereignty. Krugman has a piece up today calling it the insanity premium in the bond market. I just wonder if you think at least bond volatility is reacting to something around that.
I don't know. I think the markets should be focusing more on what it means when 1 million illegal migrants are deported from the United States in 2025. I think they should respond more to tariffs that they're going to see, not just on China, but on other countries around the world that are going to be inflationary. Those are things that matter for markets. When taking Greenland, which is, of course, part of Denmark and is a NATO ally of the United States, that's not meaningful. What that is Trump throwing out a whole bunch of crazy demands that are masking real challenges that he has with those countries, and he wants them to respond. Just like you'll remember, how much did he talk about Mexico's going to build and pay for a wall? Did they ever pay for a wall? No. But what they did was they tightened security on Mexico's own southern border to address a very real security problem that the United States has had with Mexico. That matters, and that's a win for Trump. Is Canada really going to, sort of face economic pressure to actually integrate with the United States? No, that's insane. There's no one in Canada that supports that. Not the conservatives coming in, not the liberals going out. But Trump absolutely wants to use that as leverage in the economic relationship, which he has. I mean, he's beating up on a bunch of leaders that are far less powerful than he is. He's highly aware of that.
Ian Bremmer, it's going to be very interesting. We'll talk to you a lot throughout. Thank you very much. Appreciate it. Carl, just want to reflect for a moment on what we just heard from Treasury Secretary Janet Yellen, because I think she was very open and there was a lot new. For instance, it was the first time I've heard her admit that the fiscal spending, the trillions of dollars, helped contribute to inflation. Yes, she said a lot of it was supply side and a lot of it was because of, the shortages from COVID, but did admit to that fact. She also said that she's pretty confident inflation is going back down to 2%. Didn't seem particularly worried about that point. She also, and this is pretty new, and we're going to talk a lot about this, said the CFIUS process on the review of the U.S. Steel merger was done with integrity on the merits of national security, which is the heart of the lawsuit that Nippon and U.S. Steel are bringing. So there was a lot there. And also, Carl, she said for the first time she's going to be returning in some capacity to the Brookings Institution. Wasn't sure what she was going to do next. She's done pretty much it all, but she's also going to do vacation, which is good. And she's 78 years old.
Wires picked up on her Doge comments, and we actually did go positive, maybe somewhat related to those comments about her confidence in inflation resuming its downward path.
Yeah.
Great stuff, Sarah. We'll see you back home. Let's get to the judge back at Post 9.
Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the great rate shock, whether it might ruin this bull run for stocks. We will discuss with the investment committee and tell you about some new moves our traders are making as well. Joining me for the hour today, Joe Terranova, Shannon Sakosh, Stephen Weiss, Jason Snipe. We're all here at Post 9. We do check the markets here, so we've come green a little bit, as Carl was just saying, across the board here. The big winner right now, S&P, but as you can see, not much on either side of this. Today, Joe, I'm calling it the great rate shock of 25 because that's what it feels like here. The 30-year, the highest since 2023, the 10-year, the highest since April. It's not so much just the level, it's the distance that we've traveled in such a period of time from that first cut in September. We were 371. Okay, the 10-year note yield was 371 when the Fed cut rates in September. Now it's, as I just showed you, 468. How much of a problem is this?
It's a problem because what has happened now is the equity to bond correlation has turned negative. And you really, in terms of looking at the pricing of equities on an intraday basis, you're being held hostage by what happens with Treasury yields itself. We're getting a little bit of a lift right now for the S&P and the NASDAQ. Well, if I look and see where Treasury yields are doing, Treasury yields are coming off modestly. So we have a 30-year auction today at 1 p.m. Yesterday, the 10-year auction, the highest yield since 2007. I don't think we're going to see any change on that today for a 30-year. And in terms of momentum, because we always like to talk about momentum in commodities, in equities, well, there's momentum as it relates to the Treasury market. And momentum is clearly pointing towards higher yields. It's reflected in the open interest for the Treasury future market that continues to grow on a daily basis here in the month of January. Clearly, speculators are adding to their short positioning, expecting that yields are going to continue to move higher.
Shan, how much of an issue is this for the market as it tries to, work through all of this? It's trying to figure out what the Trump administration is going to mean. Higher growth, perhaps stickier inflation, universal tariffs, maybe a new trade war. How should we think about all this? Because the market it seems unsure of what all is going to happen.
And I think there's uncertainty in terms of policy, Scott. But I think more importantly, there's a bit of certainty about the timing of all of this. Animal spirits take some time to manifest, and so if you think about what the Trump administration could do in the near term, first of all, it's digesting a lot of the rhetoric. We have to get back into this news flow of hearing something every day, taking it apart, digesting it, and seeing it incorporated into market views. But the second thing is that you talk about tariffs, you talk about immigration, and Ian Brummer just said this on the program before us. The important things are he can actually execute those changes fairly quickly after Inauguration Day, whereas deregulation, the potential for lower policy rates, this pro-growth, continued economic growth scenario that's really supporting at least our view from a broadening out perspective for the equity market, that has some legs to it later in the year. But this immediate kind of coming off of last year, Scott, we know we have large embedded gains in some of these S&P 500 stocks, paring down some of those positions, looking at immigration, looking at tariffs, looking at this uncertainty in the short term. I think that's why you're seeing the downward pressure. And I also think from a fiscal sustainability perspective, it's why you're seeing pressure on yields as well.
Weiss.
Look, it's real. The rise in yields.
Is it a real problem?
It is a real problem. It definitely is a real problem because as you get to 5%, it becomes a very real alternative to the equity markets when you want to sit out the chaos. So if you take some of the comments about maybe we should own Greenland, maybe we should own the Panama Canal, hey, maybe we should even own Canada. Now, it's unlikely any of that happens, but if you're sitting as one of our allies and you're sitting in the U.S., you've got to be concerned and you want to go to a safety trade and wait out that insanity, basically. And if you're our allies, you're thinking of how do we protect ourselves against America going down this path? If you remember how we disenfranchised our allies during the first Trump administration, that's coming again. So I'm not talking about political beliefs here. I'm just talking about what he said. And then he hasn't backtracked from tariffs, as you pointed out. And that's a major issue, which is also. So at some point, you've got to ask yourself, when am I going to take what he says as a real look into the future, and when am I going to disassociate it with reality, what can happen? So that creates nervousness, instability in a market where we've seen valuations, critical components, stay at ridiculously high levels.
I mean, is it enough to offset the optimism that has existed since election night? I mean, because the market...
It is. It absolutely is. And
it is enough to offset that. It is enough.
And I said that then, that we pulled forward a lot of the positives that can come from a change in the business outlook from the administration into before the election and post the election. And now we're going to, I think, it's going to be a very challenging market going forward because no matter what he does on the business side, no matter what he does, it can be offset by inflation. So the only thing, and I keep harping on this every time I'm on the show, inflation, inflation, inflation. Jobs don't mean anything. Wage growth means something, right? JOLT doesn't mean anything. Wage growth.
Jason Snipe, B of A says the path is now open to 5%, maybe even above that, 5.3 on the 10-year. That feels like a game-changing conversation to me that, when I sat with Gundlach, I remember obviously sitting there in L.A. at the Double Line office, Fed cuts rates, Gundlach comes on, and we're both looking at the bond market and watching yields go up. Right. We're like, that's interesting. Right. And I just told you what they've done since that day. I don't know if most people had in their playbook that back in September, that in January, we'd be talking about 5% potentially on the 10-year.
I couldn't agree with you more, Scott. I mean, I think
that, I'm looking at three cuts in the fourth quarter, right? 100 basis points. And you're talking about the 10-year at 3.7 in September and now well over 4.7. Clearly, this is definitely a concern. And I think it's not about having a decision on whether it's U.S. exceptionalism or it's inflationary concerns. The reality is the pace of rates. 100 basis points in little under 4 months is significant. And I think that, as we turn the calendar, as of course we have, and thinking about the Trump agenda, pro-business, pro-deregulation, all these different things that I think have been pulled forward since the election. And now we're kind of going through what does real policy mean. I'm turning to earnings starting next Wednesday in earnest with financials. And I think that will be positive, and I think that would be the catalyst for us to move forward.
I mean, Weiss, you're looking at moves, to make as a result of what you think could be a game changer for the rally. Most of what you're doing today, it appears to me, it relates to outside the sort of derivative play, if you will, of what higher rates are going to mean. You've loved the India trade for a while. Now you're bailing on it, it looks to me, in numerous ways, right? Through the INDA and the SMIN, both are ETFs, one related to small caps and the other maybe larger cap stocks.
Yeah, and look, I made money in the trade, but I didn't make as much money as I thought with the supply chain moving from China to India, which I still think will occur. But the element you've introduced also is that there'll be more onshoring, which was a theme already and has been a theme for a number of years. I think that accelerates because, again, that's, we talk about Trump being pro-business, but let me deal with that a little bit, right? Is it really pro-business if you get a cowardly move by Mark Zuckerberg on Meta to say, okay, anything goes now, and then what are the advertisers going to think? Now, they're not going to come out like Disney and say, hey, we're not going to be on Twitter anymore because of this, okay, because you can't do that. That's not politically correct in a different way now. But it is influencing how businesses work. That's not pro-business. That's going along to a certain narrative that the administration wants. So as part of that, I worry about tariffs coming from India. I don't worry about tariffs making good business sense, right? Because you do need some external manufacturing capabilities, some external supply chains. We're basically saying, no, we don't want anything coming from any other country into our country. So there's no balance right now.
Mm-hmm. Look, it's difficult to invest outside the U.S. right now with yields rising. With yields rising, because we're not just talking, to your point, Scott. It's a problem not just here. It's a problem in the rest of the world. UK yields, I think, are at their highest level since 2008.
Since 2008.
Emerging market yields are all rising. So that environment is very difficult to find opportunities outside the U.S. I think back to the U.S., I just think all of us, what does consensus stay on 2025? Choppy first half, better second half. I'm not saying that's right or wrong, but if we have a continued negative equity to bond correlation, you're going to have choppy
But that's
trading.
always the consensus in the U.S. because you've got strategists, no offense, that work for equity houses, that work for investment banks. They can't say it's going to be a bad 25. It's going to be a worse 26.
You don't think you guys are going too far in suggesting like this has the potential to really like offset all the positives that people think are coming?
Well, what
over
are the
next
positives?
month?
We're going to extend the tax.
What do you mean? What are the positives?
Well, let's go through. What are the positives?
Okay, they're going to extend the tax cuts.
Right, but those are already in place. That's not new.
Well, that's not necessarily in the market now.
Deregulation. Yes, it is in the market. Of course,
do you think deregulation is in the market?
No, I think part of it is. Absolutely.
Wow, there hasn't been any deals yet.
Scott, good investors go where the puck's going to be.
They don't know where deals are going to happen yet.
No, they don't know, but they know it's going to be a much more accommodative deal regulation environment with Lena Khan out. Everybody knows that. You don't know that?
Of course.
Of course.
But that doesn't enable you to invest in the companies you think are going to have some sort of
I would say
event.
I would say that interest rates were a much bigger governor on deal activity than Lena Khan was.
I disagree with that. I think,
how do you disagree? The FTC lost about everything they did.
No, I think the impact of deregulation is being underappreciated, and I think that this near-term bump in yields, and I think the concerns about fiscal sustainability, yes, will they create a negative impact on the potential M&A activity in the second half of the year, perhaps, but not for quality
They're at the
companies.
same level.
we have to monetize private portfolio companies. That has to happen because these fund companies, the big asset managers, they cannot raise another fund until they do. So I think there's going to be a realization, a come to Jesus moment, if you will, on the fact of where rates are going to be. And I think that this deregulatory impulse, combined with the fact that there is a very salient capitalistic drive to monetize these portfolio
I'll give you
companies.
the other side of that.
And just one more.
Sure.
2 strong years of public equity returns that have made valuations easier to determine. I think that all of those things are going to play into this M&A drive. For
Let me give you the other side of that. Of course they want to monetize. And they'll monetize. The only rush to monetize is when they're trying to raise a new fund.
Which
right?
they all are.
Right, which they all are, have not been able to do. But they need to get good marks. Funding away from what we hear about Anthropic and OpenAI. Funding in the private markets is still ridiculously tough. Ridiculously tough. I'm in the private markets. Half my time's there. Ridiculous.
Why, is you running for the hills? I mean, what are you doing with your
I haven't
positions?
done,
You sound so negative now.
I have raised a lot of
Seriously,
cash.
though, I mean, you sound so negative now.
I am biased towards negative, absolutely. Okay, but I still think there are enough people that think what these people think around the table.
I think
that's going to take a while.
I think choppy, and I also
So,
think the president-elect cares what happens in the stock market.
There's no
And
doubt.
we might talk about universal tariffs, but the minute the stock market declines, he's going to go, whoa. He's going to call his economic team and say, hey, put something out there to comfort the market.
Look, here's the
I just think that's
I
what
don't
we
know.
got the
You know
next
what?
4
I would
years.
only say that the difference this time is he's not running for re-election. I think he cares more about what he cares about getting done than necessarily how the stock market tick by tick reacts to what he does. I think there may be a little bit more nuance this time that, you know what, I'm not running for re-election. Here's what I think I can get done. I got the Congress, the courts are in my favor, and I'm going to do what I want to do. And if the stock market gets upset for a minute or 2 or 10, then so be it.
There might be some questions about legacy building for him. I agree with you, Scott. He hasn't really come out and said, this is the legacy I want to have. But I tend to agree with Joe that part of that is going to be delivering a strong stock market.
Yeah, look, I think choppy best case, and people have said to me in response to conversations I've had, well, we were at these rates a year ago, and as you pointed out, back in 2008, we were here at one level. But the point is, at that point, we knew the market had 100% consensus that the next move was a cut.
Yeah.
That consensus is no longer there.
So we've seen certain trades obviously have some bit of issue. Yesterday was a rollover in tech, which we hadn't seen in a while to the magnitude, Jason, that we did. It was the worst day for the NAS 100 and the tech sector at large since December 18th, right? There was positive economic data, stronger than some people, I guess, expected. Yields go up, tech goes down. NVIDIA is trying to get a bounce back after the rout that it had yesterday. That was the worst day in months for the stock since September. CES now in the rear view. How am I thinking about trades like that today?
Yeah, no. So, I mean, obviously, for NVIDIA, I think the big thing for me, forget about CES for a second, the last 6 months has been relatively flat for NVIDIA, right? There hasn't really been a seismic move there. There was a lack of, not necessarily innovation talk, but what is the here and now? What's going to happen in the near term? And I think that was, somewhat of a letdown, and that's why the stock kind of traded lower. But when I think about semis broadly, I start to think about, and I continue to love the NVIDIA story, but we're hearing from the hyperscalers, we're hearing more about them developing their own chips, their proprietary chips. So I start to broaden out my scope in the semi space and start to think about some of the, companies like Broadcom, companies like Marvell that are doing custom made chips, that I think that those names could kind of get a nice run here coming in the over the next couple quarters. So for me, I don't think that the tech trade is disrupted terribly. I just think that CES was a little bit of a downer.
If I could on NVIDIA, I said the other day that I believe that the keynote address would lead to a new all-time high. Check the box. Got the new all-time high. That's not me patting myself on the back. No, because guess what?
Well, history,
no follow-through.
History. Well, see that's.
You're right.
I was
all right. So last year, goes to CES. He, gives his keynote, and the stock goes up, and in the subsequent 2 days, it goes up more, and it stays up. So it was sort of telegraphed that the stock was going to go up. It did into the event. But it didn't stay there.
Didn't stay there. You didn't get the follow through. And let's kind of walk through that and explain how I think the viewers need to manage or shape the risk surrounding yesterday's move. It's very rare to see a stock trade to an all-time intraday high and then close challenging the 50-day moving average. You can't ignore that. That has significance. I think that there also is an element that you have to acknowledge that NVIDIA, despite all its strong fundamentals, the stock has been gamified. When you have all these ETFs that are double levered and you have exposure of algorithms participating, I think a lot of that contributed to what you saw yesterday. So if you're a buyer up at 150, or if you're a buyer up near those intraday highs, you have to take a look at where price is today and understand the momentum in the near term is down. And I know that's not something that is normally said, because most people say, okay, and Jim Cramer's right. Own NVIDIA as a core holding. Don't trade around it. But there are a lot of people that are trading around NVIDIA. There's a lot of tactical elements surrounding NVIDIA. And let's just acknowledge that what I expected to happen did not happen. And now the momentum is rolled over. You've got negative momentum in the near term. It doesn't wash away the long-term strong fundamentals of this company and the belief that you want to own it for the long term. And it will make a new all-time high at some point in the future.
Hey, how about AMD today? Got double downgraded to sell from buy. We had some calls of late that you just don't see all that often. This is a big one because it's a two-step move, okay? The target to 110 from $200. This firm says they see additional downside as they now believe its AI GPU roadmap is less competitive than we previously thought. Weiss, you've talked about, I know you don't own AMD, but you have talked about one of the threats to NVIDIA being, well, it's only a matter of time before competition comes online to take this company on. Now you have this call on AMD today by HSBC, which says not so fast, not so fast.
Well, I never thought AMD would be competitive.
Whomever we're talking about.
Well, no, it's an important distinction.
There are only a few companies that are even in the queue to be competitive.
Right.
Okay?
And those few companies that are in the queue are the biggest customers of NVIDIA, which you referenced, the hyperscalers. They have R&D budgets that far exceed what the R&D budget is for AMD. So that's where the weaponry comes from, to compete with NVIDIA, not to be held hostage by them. And the reason why the stock sold off is that what he talked about was not the euphoria around data centers anymore. Of course, that was mentioned, but into the other areas like robotics. Look, NVIDIA has been writing $50 million checks to $100 million checks out of their venture fund like they're going out of style, like you guys will tip on a weekend meal at a coffee shop. That's how many checks they've been written. So they are searching for the next avenue of growth for themselves, because they know, as they should know, as every company does, the great times don't last forever in a product because water finds its equal level. So look, I debate NVIDIA all the time. Is everybody too, much in this state of denial that there can be competition? And it's never been a core position for me, unfortunately, because it's done so well, but it is a position. So it's when I look at it and say, where could I go where everybody's not so built up on it? But as yet, I hasn't pulled the trigger.
Does anyone own AMD on the desk? It's in the ETF.
You do.
We have it. And I'll tell you right now,
Massively.
Relative to Broadcom and NVIDIA, absolutely correct. I think right now, current PE, 103 on AMD. Momentum clearly red for this stock. Rebalance January 31st gets dealt with accordingly, but it certainly doesn't look good. And that's an environment where you had a really strong end to 2024 for a lot of technology names.
It was so asinine to have to have AMD for the entire year trade at a higher valuation than NVIDIA. It made no sense. What were people thinking? That all of a sudden it's going to be this great technology leader? It never has been. It's been an alternative to Intel its entire career until Lisa Su took over, and she made it a little better, but not great. And Broadcom, I think the bull case there is also overstated because it's not as pure play in data centers. They've got a lot of cyclical companies, cyclical products in there as well. So I'm not a Broadcom owner.
All right, so there's another name I want to get to because it's a new stock that Joe Terranova has added. It's Teradyne, right?
Yeah, the other day I mentioned look, risk to reward is important in this stock, and I said we're using 125 as the stop out level. It appears as though this semi-equipment name is finally gaining traction in terms of AI facing exposure. It's also breaking out technically. So you take a look at the chart, you see it here in the mid 130s. I said on Monday I would buy it. I did that on the close. You have to manage a type stop on this one. And if in fact we have moving forward a choppy equity environment because of this negative equity to bond correlation, it's going to fall victim to the overall market itself. And I think a lot of individual stocks are going to do that as well. So I'm keeping a type stop.
All right.
here.
I want to do some news, what we're calling New at Noon today. It's an exclusive that we've just got our hands on. It's Nelson Peltz's Trian Partners sending an open letter now to Solventum shareholders today. That's the healthcare spinoff from 3M. 3M doing that earlier in 2024. Trian holding what I understand to be a near 5% stake in that company. First took its position last year, has added to it a bit. In terms of what the letter says now, Trian wants the company to release a plan to, quote, restore performance back to the levels that it delivered inside of 3M, and says that if it does that, that shares can reach $140 by the end of 2027. That's far higher than the $69, $70 that you're watching it trade right now. Trian also making it clear in the letter that it was in favor of that spin, that it set Solventum up for better long-term performance, but now says that, quote, performance has taken a major step back. It says the company trades at a discount to its peers and even 3M itself. Quote, in a short period of time, Trian says, this company went from being 3M's best performing division, consistently growing revenue organically at a low to mid single digit rate and mid to high 20% profit margin under 3M, to one that is barely growing at a low 20% margin standalone. The company is expected now to release its long-term plan in February. You can see the stock is getting a bump off this letter that is going to be made public at some point today. Again, by Trian to Solventum shareholders. Weiss, you want to comment on this? I mean, Trian has participated and been involved in other healthcare spins, right? Yep. GE, Vernova, and GE Healthcare. It understands not only a spin well, but certainly one within the healthcare orbit. And here they go, sort of up in the ante and the pressure on this company, which they like, and they like the spin, but they think it can do a lot better than $70.
Yeah, and look, Pelt's a smart guy. He does put together, obviously, very thoughtful analysis of companies and how they can grow. And this company will need to grow, because right now, as I'm looking at forecasts, you've got basically flat earnings, flat revenue, flat EBITDA, flat earnings going forward. So on that basis, in this sector, it should sell at a low double-digit multiple. Now, what I'd also say, though, is that companies have become much more emboldened in telling, activists that, hey, thanks, but no thanks. What are you going to do about it? You don't know enough to influence the board, and we're set. And this is a new board relative to the spin out. Sure. So I don't expect much to happen there.
Well, I mean, this would, I guess, fall in the line of what Mr. Peltz tries to suggest he is anyway, more than an activist, but a constructivist. Now,
and that's BS. Okay,
but let me finish what I'm saying. Let me finish what I'm saying. There's nothing in here that says, well, we want you to, do this buyback or this or that, or really push for financial engineering, if you will. This somebody who likes the company a lot, who agrees that the spin was a good idea. So he's not coming it from a highly adversarial point of view. It's like, look, you're coming with your own long-term plan. We have some ideas of our own. Let's try and work together to get the stock to 140, not 70.
If you're truly being constructive, you do it behind closed doors. You don't do it publicly unless, Scott, that's how it works. And unless the company has rebuffed you and doesn't want to listen. And if that's the statement he's making, then it's antagonistic. But when you say it's constructive, look at what Disney, right? I think this stock could double.
I'm saying that's what he consistently says he is and tries to be.
And I consistently say I'm 6'5" and play in the NBA.
Well, we know that's not true when it comes to you.
And I know
not only have I seen your real height, but I don't even need to see your basketball skills to know that's BS.
My skills are good.
Okay.
My day, baby.
To see that's BS.
But no, look, Well, it's a cheap stock. It deserves to be cheap. If he can get the company to adopt some of his suggestions, then fine, it's going higher. But I guarantee you, and I'll bet you right now, that he's not staying there for 140. He's getting out, and there's nothing wrong with that. He's there to make money for his investors. So overall, yeah, it's a good target because it's got a very strong base.
He's been a pretty long-term holder of the stocks that he's gotten involved in, particularly ones where he's taken enough of an interest to release like a letter to shareholders. Right. So I'd be shocked if he. I mean, what are you suggesting?
His most recent Disney, was he a real long-term shareholder there?
I mean, he was in there for a while.
Yeah, but because he got stuck, because it was underperforming, as soon as he got some relief and it moved up, he got out. Right?
Well, he's been in a lot of names for a while. Anyway, we'll follow the story.
Yeah, but it's not about him. It's a decent name to target.
Obviously, the stock is getting a bump off of our reporting here, and we'll follow that for the remainder of the session. We'll do calls of the day next, including a big downgrade for one of Steve Weiss's favorite stocks, plus a double upgrade for one of Joe's names. We're back in 2.